Hi there, my name's David Cross, and I'm a certified portfolio manager with US Asset Management. And today we're going to talk about a concept you've probably heard of called buy low and sell high. That always works, right? Wrong. It doesn't always work. And we think there's maybe a little bit better way to go about doing things. There's an author named Bill O'Neill who published the book called How to Make Money in Stocks. And he also publishes the Investor's Business Daily newspaper that we use as a tool and a resource to help us be successful. And in this note, we're gonna share what Bill came across many years ago, which is the concept of buy high so that you can sell much higher. So let's go back in time and take a look at a common stock that most people would have probably looked at back in 1999. The internet bubble was running, stocks were running up at the time, and General Electric, which was a huge company, had run from around $35 a share up to around 58. And about a year or so later, it had pulled down to around 38 bucks a share. And there's some investors that said, you know what, I missed that run up to $58 a share. I'm going to go jump in. I'll buy some stock at 38. And when it gets back to 50, I'll make a nice little profit on it. So let's say you buy 200 shares at 38 bucks. Your cost basis is now $38 a share. And when it gets back up, you'll be able to sell it at 50 and make a nice profit. So from your buy at $38 a share, the stock later drops to $24 a share by late 2002. So here you go, Christmas of 2002, you give yourself a Christmas present, you buy 200 more shares. You double up at $24, and now your cost basis is $31 a share. Some investors might be selling down there, but not you. You're the wise investor. You're going to buy low and sell high. So then you sit and wait. From 2002, you sit there and wait patiently for 5 years, a very long time. And in 2007, the stock finally gets up to a high of around $40 a share. Your cost basis is 31. You've got a reasonably good profit, but you're waiting for 50 bucks because you're going to make a bunch of money. And you're thinking, I'm getting close. One day it'll get up there. And you're so close. And then the stock drops. In the financial crisis of 2008, GE stock sunk as low as $6 per share. Now, mind you, it was only there for one afternoon. But you might say, I would have bought some stock down there, but we're going to assume that you didn't because most people were frozen with fear, concerned that their bank was going to go out of business and that the money in their pockets was going to be worthless. So you didn't buy then, neither did anybody else. All right. So by 2010, the stock stabilizes up around maybe $15 a share. It got as high as around 19, but it stabilizes at 15, and you decide to go buy 200 more shares. So now you've tripled your position. You have 600 shares with an average cost basis now of 26 bucks a share, and that's in 2010. So then you wait patiently again for 5 more years, and by 2015, General Electric stock is back to 26 bucks. You're at break even. We started this process about 12 years ago. You would have been better off on a money market and not had to fiddle with the stock market and worry about the stocks going up and down. But you're going to hang on because it's General Electric. It'll come back. So the next year, the stock reaches $33 in 2016, and you're thinking it's finally moving. There's going to be some more gains, on the way. Your cost basis was 26. Now it's at $33. You're waiting for it to go a little bit higher, and that was the peak, and it starts to drop rapidly. And by the end of 2017, it's down at $17.45. And so now you're sitting on a loss. Your cost basis is 26. It's now at 17. You're thinking, you know what? I'll go buy another 200 shares. It's General Electric. So you do. And now your cost basis is $24 a share. Now you're going to sit and wait for it to go back up. If it makes it back to 50, you'll double your money after 17 years. Well, forget 50. You know what? If it just makes it back to 24, you can get out of this disaster and move on with your life. Well, that doesn't happen. The next year, the stock hits a low near $6.66 in December of 2018. So it's $7.50 a share. That Christmas, you're giving yourself Christmas presents. You double your position. You buy an additional 800 shares at $7.50, thinking I'll pyramid this thing up, and when it goes up, I'll be able to make some money. So now you have 1,600 shares with a cost basis of right around $15.50, and you wait. And then the pandemic of 2020 starts because it never got back up, and the stock finishes the summer at around $6.41. Your 1,600 shares that you bought and have $25,000 wrapped up in is now worth a whopping $10,256. You managed to more than cut yourself in half. So what happened? This was a high quality blue chip stock. Blue chip stocks are supposed to be safe and make money. Not really. In my book, the only good stock is a stock that's going up. So let's take a look at what might have happened if you had bought Amazon like at the worst possible times. Okay. So from 1997 to early 2000, Amazon stock surged from around $2 a share all the way up to $113. And excitement gets the better of you. And you say, you know what, I'm going to buy 50 shares of this expensive stock all the way up here to 113. So you buy it. And shortly after that, the technology stocks drop because it's the dot-com bomb hits, and the stock drops like a rock all the way down to $61. By late 2003, Amazon has, it bottomed out all the way down here from 61. It continued going lower all the way down to right at, looks like around $6 or $7 a share. And things finally stabilized. And by late 2003, it's back up to $60 a share. So you buy another 50 shares at the worst possible time. And so now your cost basis is $87 for 100 shares. You have $8,700 tied up in this thing. Over the next few years, the stock is really volatile. You bought it at the high again in 2006. And the stock has, dropped all the way down in 2006 down to $26 a share. But you see that the company's sales have been growing rapidly, and more of your friends are using the service. And by 2007, the stock rockets all the way back up to $100 a share. And excitement gets the better of you again, and you buy another 50 shares for $100 a share. You now own 150 shares with an average cost basis of $91.33. That's a total cost of $13,700. By 2008, you know it, you saw it before, the stock market crashed. It takes everything down. It takes down Amazon with it, and it crashes all the way down to $35 a share. You're freaked out like many investors, so you don't buy any more, just like you didn't buy any GE, and you wait it out. And a little while later, the stock recovers back to $135 a share. The crazy thing is that Wall Street analysts hate the company because they're not generating any net income. Amazon's reinvesting all the money into the company to make a bigger, better, faster Amazon. And so when it gets up to $135 a share, you buy a final 50 shares at $135. Your cost basis has been raised now to $102 on 200 shares, and your total cost is $20,450. Again, 200 shares, average cost of 102. Your cost basis is 20,250 shares. And you leave it alone because every time you check it out, the service is doing great. Jeff Bezos is in the news. The company seems like it's going well. And so you leave it alone. And over the next few years, Amazon's sales growth is explosive. And by the summer of 2020, the stock is volatile again because of the pandemic that's going on. But now the stock is up around $2,700 per share. And your investment is now worth $487,000. So what happened? You were supposed to buy low and sell high. But instead, what actually worked was buying high and selling much higher. Thanks for watching. We'll be having more videos in the future. And if you like the video, I encourage you to reach out to us and see how we might be able to help you. Thanks for watching.